What is the global view on India? Who better than Hugh Young, Managing Director, Asia Pacific Region at Aberdeen at Standard Investments, joining in the show right now to really give us his thought and perspective. Hugh, morning. Hi, good to have you on the show. Along with rest of Asia, Hugh, India as well is seeing that slight bit of recovery. But would you say that it's too early to say that the world is out of the woods and the coronavirus impact has been done and digested in the week gone by and the carnage we felt?
Good morning. I think it probably is too early, I'm afraid. I'd love to say now is the time to be buying and everything is over. But clearly the virus is still spreading in countries. Today, Indonesia declared its first cases, and we're seeing more and more cases throughout Europe as well as North America. So I don't think the virus is over. I think the supplies to the the disruption to supply chains is likely to continue. And clearly it's having a dampening effect on the global economy. Now, of course, trying to relate that then to the stock markets is what makes life rather difficult. We saw a very, in a sense, delayed reaction in stock markets, certainly global stock markets, because we saw initially a sharp drop in China, then a recovery in China. And only in the last week or so have we seen markets outside Asia really pay attention to the virus. And of course, the pullback was very savage in certain cases, in double-digit, almost up in double-digit percentage terms, which is quite a sharp reaction. And possibly, arguably, too much of a reaction just on behalf of the virus. But when you put into context the fact that markets have been so strong for so long, in a sense, it's quite a muted reaction, and we're seeing the inevitable rebound. And then I think markets will continue to watch the numbers very closely on those infected and of course, sadly, the deaths as well.
And, like you rightly pointed out, Hugh, it's kind of intriguing as to how suddenly the world markets reacted to it much after the outbreak, I would say almost 2 months. But anyway, on the point that you were mentioning, that don't be a cowboy, don't jump in to buy the fall just yet. What are the signs that you would be monitoring as to when you feel, valuation-wise, say in India or for that matter, US markets, if you're tracking the S&P 500 or the Dow, reach the value zone?
Well, for us, it's just a matter of trying to relate share prices to each company's outlooks. There are certain companies that will be far less affected by what's going on from a macro point of view. So it's a matter of what we do is set price targets. And, for example, yes, we'll be trying to buy some stocks today as we were last week, buying bits and pieces, never quite knowing where bottoms are going to be in markets. So I think it's very hard to call it precisely. And one of the things we've certainly worried about, in particular in India's case, has been the level of valuations in India. And of course, the simple fact that the Indian economy hasn't quite been firing on all cylinders either. So even before this, India wasn't really achieving its true potential, and had been a little disappointing from the point of view of earnings growth. Not necessarily that dissimilar from elsewhere in the world, where the economy generally remains a bit sluggish, with but a few bright lights. And of course, that sluggishness looks all the slower, courtesy of this virus.
But you're long-term guys, Hugh. So how is it that you approach this catch-22 situation in India? Do you protect capital? Do you profit take right now? Or do you deploy this dip to start nibbling in, like you mentioned?
Well, it's always hard for us. We don't have unlimited capital, and certainly what money we manage is on behalf of third parties. And typically when markets go down, that means that third parties typically take money out. So in one sense, you're almost a forced seller, when by nature, as a long-term investor, one would like to be buying when things get cheaper, providing the world's not going to end. So for us within the portfolios, it's more a matter of maybe of rejigging the portfolio slightly. So taking the money out of certain areas that have done very well, held up, remained expensive. It could be a combination of those things, and adding to hopefully equally high quality stocks, but where the share prices have been hit because, of course, maybe short-term earnings have been affected by what's going on, or simply it's a matter of sentiment.
That's a large category of stocks when it comes to India, where the share prices have been hit and growth, continues to stick by. So what's of interest to you?
Well, again, we're holding on to some of our long-term winners, the HDFCs of this world, our exposure in IT services, again, Infosys, TCS, and the like, and some of the consumer stocks. Hard to argue that many of those are cheap, of course. Ratings on many of the consumer stocks, many of the high-quality private banks are still high. But again, that's where we hope that the long-term growth is going to come from, and when we can be semi-relaxed, given our long-term vision for these companies, and they still seem to be the right companies to have long-term exposure in. But of course, short-term, their share prices can fluctuate wildly, as indeed we've been seeing, as indeed is happening elsewhere in the world.
Still leaving us wondering what some of the new names could possibly be, or if you could guide us into the general vicinity you're looking at when you mention those high-quality beaten-down names.
Yes, it's probably not so much new names for us, although of course new names do crop up from time to time, but many of the names in our portfolios we've held for 10, indeed 20 years in quite a few cases. So more a matter of moving out of one of the existing names and or taking profit, hopefully, from one of the existing names, top slicing it by, say, 0.5% and adding to something else. I mean, our turnover in our portfolios remains fairly low, as you would expect from long-term investors.
Banking names or IT?
It could be either. Again, if the banking names fall sharply, we could be adding to the Kotaks, the HDFC banks, the likes of that, or indeed from time to time, as we have been to the IT sector as well. So it's not terribly sector specific. So we're not making major moves out of one sector into another. It's just very stock specific and very at the margin.
Hugh, I understand, and you're saying in India you would do a bit of a juggling act given that, or jiggling rather, given the kind of valuations we've seen here. Overall, though, and if we see the global situation right now, would you remain risk off? Would you see the current situation put it down to volatility in the near term, or actually see a larger concern as we're hearing on some fronts on the impact on growth going forward?
Well, clearly there is going to be a big impact on growth for this year. The question mark remains that when things do settle down, will we see a very strong rebound, or will it remain still fairly subdued? And we don't know the answer to that. So I still think it's going to be a time of volatility, but for investors, of course, one should frequently embrace that volatility, although it can be painful short term. So for people who are comfortable 2 weeks ago, 10% higher, should they be sort of looking to top up holdings? Yes, I would have thought so. But of course, that depends on personal circumstances, and that's where cash flows matter. So it's an easy thing to say, buy more, but if you're fully invested already, that's not so easy.
Absolutely true. Okay, Hugh, we'll leave it at that. Thanks for dissecting what this unknown situation is really throwing up. Today, fortunately, you're seeing a good rebound kick in for the markets, and we're holding on to the gains. In fact, at the high point of the day, a good 185 points up in the green for the Nifty futures.